and futures. Not much changed here before the opening bell after what has been a week of some pretty wild swings up and down for the major averages. This morning, we got the confirmation of a change from the Federal Reserve to bank capital requirements that had been relaxed amidst the pandemic. Now they're going to be tightened again as of April. That could have an effect on the bond market. Julie Heinel is joining us now. She's Deputy Global Chief Investment Officer for State Street Global Advisors. And as we've been talking about, this was an expected change, Lori, but still just adds to the sort of heightened sensitivity and heatedness of what has been going on in the bond market. Are you concerned about that change? Are you concerned about yields generally?
So first of all, not particularly concerned about that change. I think one of the things that the Fed has done under Chairman Powell is they've been incredibly consistent and incredibly open about what their trajectories are. And I think this is consistent with everything that they said. And in the context of their broader accommodative stances, it's something that we're particularly concerned about. On the yield front, I think there's this dynamic playing out where there is growing enthusiasm about the global economic recovery that should engender higher yields. But when you think about it anchored against very accommodative policy, the idea that inflation is still not really a threat, and concerns about what the sort of ongoing organic growth rates are, we actually are using the backup in yields as buying opportunities.
Interesting, Lori, you said that. I haven't heard that much out there yet. But on the 10-year, what level would concern you? Because for the most part, we've seen volatility in tech shares, but the rest of the market has been holding up well. What point does the broader market get repriced because of a 10-year? Perhaps that goes over 2%.
Yeah. Yes, I think that's the key dynamic is if you start to see a 2 handle, then there's a broader impact, if you will. I mean, certainly some of the higher growth sectors are at relatively high valuations. And so these moves are really more of a function of those relative valuations coupled with a rotation, because, of course, there are other more attractive opportunities against a backdrop where growth is likely to be higher than it has been. But when you start to get up over into the 2 plus, then you might see some portfolio repositioning. So that could be a bit more of a threat. But there again, if it's against a backdrop of still heightened economic activity, nothing that we think would have to derail the market so much as just some repositioning.
I mean, Lori, I guess in that context, what are your clients most worried about right now? And I ask because it seems like every conversation we have on this program comes back to inflation, which not only did we hear a lot from Jay Powell about how he thinks that will unfold, but that has not actually yet materialized. It is only the fear of said inflation that is part of the conversation today.
Yeah, we think we're in kind of a sweet spot here, at least for the next 12 to 18 months as we start to see this global economic rebound, and likely not just 2021, but into 2022 as well. And certainly the economic stimulus package has made the U.S. especially in a sweet spot for equity investors. But there is a reckoning at some point in time, right? And I think we've pushed that back a bit. And certainly the market's concerns about inflationary pressures are justified. We just don't think that that's a today problem. As we get to the back end of the year, though, and the Fed does have to confront whether the recovery is sustainable, whether there are actually employment starts to get to a point where you start to get a little bit of wage pressures, that would be something that would be of concern. And of course, the markets are forward-looking indicators. So where does the market start to get too far ahead of itself? That's what we'll be watching carefully over the course of this year.
I want to switch gears, Lori, because you guys recently published on Bitcoin and cryptocurrencies. And because, as you know, there has been this huge movement among some institutional investors to get more into Bitcoin, to open up their, perspective to it a little bit, I guess. Yeah. It seems as though you guys are still taking a little bit more of a nuanced, cautious stance when it comes to crypto, if I'm reading it right.
Yeah, we definitely are. And again, to your point, we published a paper where we tried to think of it from a pragmatic standpoint. If you're an institutional investor, how should you think about Bitcoin? Is it a new asset class? Is it a currency play? Is it something else? And what we find is that despite all the enthusiasm, it just doesn't hold muster when you evaluate it in the context of your portfolio choices. It has a lot more volatility, which clearly gives it the opportunity for an outsized gain, but it also gives gives it the opportunity for an outsized loss. If you look at the correlation between Bitcoin and other asset classes in the portfolio, it's not very stable. So it's hard to think about how you would use it as a substitution. It doesn't provide the kind of drawdown diversification benefits that places like gold provide. So we're still struggling to see how it fits in an overall portfolio context. But as you say, there are lots of things that could happen over the coming years that would make that position quite a bit different.
Where do you think it could fit, Lori? If you had to put it in there, where would it go?
Yeah, I think if you had to put it in there, you'd put it in there as a high volatile, high growth, kind of high expected return asset. So it would get a very small allocation, but it would be something that would be at the extreme end of the risk spectrum.
Sounds about right. Lori Heinel, thank you so much. Deputy Global Chief Investment Officer at State Street Global Advisors. Good to catch up with you, Lori. Thank you.